Hey everybody, JC here. I'm with David Keller. And one of the things I really like about David is the way he thinks, not just about the market, but about the psychology behind the investors. And one of the things I've had on my mind recently, and I wanted to do a video, so I just grabbed him, to pick his brain about people's inability to say, I don't know.
Right.
Right? So why is this so hard for investors?
It's a huge issue for a number of reasons. I think number one, it speaks to overconfidence. So we are hardwired as humans and especially as investors to stand behind mentally the decisions we make. We don't make decisions expecting for that to be wrong immediately and have to, unwind what we did. We, especially as investors, we do all this work, all this thinking, all this planning. You put the trade on and then it goes against you. And so there are so many psychological reasons why you want to just make that work, because you want to be right more than you want to be wrong. The problem is, a good investor a lot of times is wrong half the time, or more, right? And even the best investors that I've been working with are right 53, 55%, of the time on average, which means you're wrong almost half the time, which means you have to be able to admit that you're wrong. And so what I love about the technical toolkit is it's designed to tell you, or it's your report card. It informs you when your call might not have been right, or maybe just the timing was wrong. But as humans, we are so wired to not admit that. I think on the institutional side, it's even more challenging, because having worked with junior analysts, we teach them to pound the table, have conviction, get people to believe in what you're doing. It's not, be tentative and think about when it might not be right and then go and promote how wrong you were. And so I think, culturally as an industry, we have primed people to not approach being wrong as often as you're going to, and how to handle it well.
And what about the conflicts of interest, right? So, if you're getting on the sell side, right? If you're getting a call from a hedge fund or whoever it is, and they want an opinion on a stock, you better have an opinion, or they're going to call another desk and they're going to have an analyst with an opinion, and they're going to get the trade, right?
That's right. And so, and to be honest, I think with on the sell side, you have the challenges of just the optics of being wrong and what that means. And so what happens is you tend to move mentally past bad decisions, focus on your good decisions. So you will always have analysts stand up and talk about their great call, their career call, their best call, because that's something that they want to remember. They have a very short memory of their really bad calls.
There's still people milking their 1987 crash call.
Completely. But to be honest, what's the better thing for us to do? It's forget our good calls and focus on our bad calls. Right. And so a lot of times when I'm coaching investors, it's, keep good track of all your decisions and go back regularly and focus on your poor decisions and really pick apart what was the decision tree, or what were the steps that you took to get to that decision? And was it just the market was not the right environment? Was it something that's missing from your toolkit, something you misinterpreted? But learning from our past mistakes is something we don't like to do, but I would argue is probably the best thing we could do to have investing success in the future.
But David, it's not my fault, it was the market's fault.
That's right. So, and I was going to say, that's another thing is when you're right, you tend to credit your process, right? My process was fantastic. When you're wrong, well, the market was just wrong. And we need to flip that.
President Trump, the Fed.
There's so many things. You can blame it on anything, but in general, you can't credit your process too much. You have to think about just the role of luck, the role of randomness, but also the fact that, sometimes your process is incorrect. Even you might have had good returns, but your process might not have been as good as it could have. So having a regular routine where you go back through your decision, what are the steps you take to come to putting a position on, and how can you optimize that? How can you get rid of things that haven't been working and add things that have? And that, conferences like the one we're at, the CMT Symposium, I think are so good for that, because it forces you to revisit your own convictions and your own, sort of tried and true things and see what else you need to pay attention to.
Don't confuse a genius with a bull market.
One of the many things we can do, right? And that's true. And especially now we're at this point where the market's gone up so much, technology going vertical, semiconductors breaking out to new highs, the XLY at new highs. And so it's very easy to feel just very, rest on our laurels and feel very comfortable. What worries me now, talking about being wrong, when this market turns, which it will at some point, I'm probably more bearish than most people I've heard from today. I'm a little more cautious. I think limited upside, and I think there's potential downside. I think when it happens, it'll be more painful for a lot of people, both in return terms, but also mentally, because we are so primed for this market that's just going to keep going higher. And people are going to have to admit that they were wrong and that they're positioned on the wrong side. And I think that's going to be a tough learning experience, especially for younger investors that have only been doing this for a couple of years and all they know is a cyclical bull market environment. It's the other one's really difficult, it turns out.
And then let's just finish up with the financial media. I mean, I try to consume as little of it as possible. I mean, obviously it's impossible. You know, we're on Twitter and you could see like a clip here and a clip there, especially if they're my buddies, you know. When
I was going to say, except I'm on or you're on,
right,
then of course we watch
you know, Ari Wald or, you know, Varone. I was like, ooh, I'm kind of curious to see what he has to say, you know.
Right.
But like, other than that, I try not to consume it all. But if you watch it throughout the day, God bless your soul if you do that, you'll never hear a guest, you know, be asked a question and them say, you know, I don't really know.
So, no, it's true. And I've told people before, I mean, having done a good amount of financial media, you have to compress. I always tell it, here's what it's like. Take a 1 hour, well thought out, well articulated presentation and boil that down to 3 minutes of sound bites. And that's what you're being asked to do, which means I'm getting rid of 57 minutes of pretty good content that probably would help, sort of flush things out a little bit.
Put things into context.
And put things in context, but you don't have time for that. And so to be honest with you, I found it's good as a starting point to help you think about what you want to dig into further. And if you treat it that way, it's good. All right, Ari mentioned something. Let me dig into that a little more and come to my own conclusion. I think it has some value there, but you're right. It boils things down. It simplifies things probably too much.
Yeah, you know, I like if you're going to do the media, do the soundbite, and then write a blog post about it and embed that video, and then put everything else, within context, around it. I think that's a good idea.
Agreed.
We'll wrap it up there. I just want to be perfectly clear, if I were asked today what the market is going to do next, I have absolutely no idea. I'm happy to say it.
I don't know. There we go. None of us do.